doing DeFi, greatest in the world, and they finally about to see why. What you know about XRD? I'm smart money, I ain't never on a decline. What you know about NFTs? It's not just Ace, when you finally gonna realize you need scalability, need more utility, then you better call on these guys. I'm going radical, I'm going Radix, I'm going radical, I'm going Radix. Hyperspeed DeFi, never on a decline, building the future, I feel like a savage.
Hello and welcome. I am Piers, CEO of RDX Works, a core developer of the decentralized finance protocol Radix, a public ledger entirely focused on bringing DeFi to the mainstream. This is our podcast, The DeFi Download, a show about decentralized finance and all things crypto, where we dive into the details of the projects, assets, and services that are driving the DeFi revolution. Today, I have Ahmed Ismail, founder and CEO of FLUID. FLUID is an AI-based liquidity aggregator for CeFi and DeFi. Ahmed, welcome to the show.
Thank you. Good to see you.
So let's just go from the very top. What is a liquidity aggregator and why do we need one?
Great question, Piers. Liquidity aggregator aggregates liquidity across centralized and decentralized exchanges.
Yeah.
Why do you need it? Because the biggest problem in crypto at the moment is that liquidity is highly fragmented, meaning that liquidity is held in very, very few places across the universe, meaning that unlike the traditional markets, such as the equities markets or the FX markets, where liquidity is everywhere, in crypto, we're about 20 years behind the game. So what we do is that we solve this problem using AI-based strategies.
Okay, so when you say liquidity, you mean the sort of the tokens that are available to purchase on exchanges. So
Correct.
Right.
So if we even look at just Bitcoin,
Yeah.
Any crypto asset really, crypto assets are held in very, very few locations. There's not much liquidity to go around. So when there's a market crash, like what's been happening over the last few months, first with Luna, now with FTX. Supposing you're a trader, you hold, doesn't have to be Bitcoin, it could be any asset. Everything is on one exchange. You want to get out of that position. You're a trader, you need to get out. What happens is because crypto is held in such few places, you get huge market inefficiencies, flash crashes. You get people manipulating the markets, very wide spreads, and meaning that buying and selling crypto is actually really, really expensive. Mm-hmm. Not the fees associated with blockchains, but actually getting in and out of positions. And that's what a liquidity aggregator does, is that we solve that problem.
Right.
So a good example of that would be if you're buying a flight.
Yeah.
If you're buying a flight, you're buying a flight. A lot of people use Skyscanner.
Right.
And they want to go from London to New York.
Yeah.
Instead of going to British Airways or United or Virgin directly, you go to Skyscanner and you'd find the cheapest flight for the times you want to fly.
Yeah.
Right. That's what an aggregator does. It gives you all the options in one place, so you can get the best possible price at the best possible terms that you want.
Right.
And that's effectively what an aggregator does.
I suppose it's an interesting analogy. There's some key differences there, I suppose, which is that when let's say I want to trade Bitcoin for USDC, I'm getting out of the market like seemingly everyone is at the moment. Or let's say, let's be bullish and buying Bitcoin with USDC because everyone else is getting out the market. So now's a great time to be getting in. And instead of going to my Binance account or my Coinbase account or whatever, I instead go to FLUID. And what FLUID will do is, let's say I want to buy $100,000 worth of Bitcoin. What it will do is it will go, okay, if I take the first part of the order book of all of these exchanges, you'll end up getting a lot less movement in the price, because instead of 100,000 coming off in one hit on just Binance, I'm taking maybe the first 5,000 or 10,000 block of Binance, and then the next first 10,000 block of Coinbase, and then maybe some off Uniswap V3 to aggregate together all of these different places, so I get the best price or the least slippage possible across all of those exchanges.
Couldn't have said it better myself.
Right.
Exactly. That's what we do. Dan, what you just described is called smart order routing.
Yep.
So it basically looks at all the order books
Yep.
and says there's least slippage if I get it from 20% from here, 10% from here, 5% from here, and aggregates all the orders into one place and gets you the best possible price.
Yeah.
The reason this is important is what's called best execution.
Yeah.
It's something that's, as we all know and have seen, compliance and regulation is missing in crypto at the moment. There's been the debate on regulation has been well documented, and we've seen what's gone on with FTX, etc. I won't go into that, but what I will go into is what's called best execution. A concept in financial markets. So my background is I'm an ex-banker. A big concept in financial markets is best execution, i.e., if you're a broker, getting the best possible price for your client or your customer, right? Without screwing them, without playing them. And if you get a better price, you have to give them that price. Your fees should be set in stone, and you should not be making any more money on the back of a customer, right? Just being honest, really, as a broker. And what smart order routing does is that it gives you the best ability to serve people who want to buy or sell a certain asset in the best possible way, the most honest possible way. And what that does is when you give best execution and when you get the best pricing, you'll encourage more flow. And that's how we solve that problem. More and more, the better price I give you, the more likely you'll buy from me. And that's pretty standard.
I mean, that's your customer acquisition strategy, right? I suppose from an ethical point of view, the thing you're pointing to is that most of the time in traditional financial markets, you're required to go to as many exchanges as possible to be able to get together the quotes for a particular trade so that you can be able to give your client the best price.
Correct.
Interestingly, as an aside, and I'm sure you're aware of this, but the listeners may not be, it's part of the problem with that actually caused a bunch of the quant trading houses to be able to make their money in the first place, but via trading against those signals. You could go, okay, this order's come in on this exchange to see on this kind of execution. I'm going to race to another exchange to buy up the rest of it, which I suppose maybe goes into some of my questioning about, that makes sense. So far, what you've said sounds like a relatively simple problem set. You create APIs to all of these exchanges. You aggregate, tick on tick the order books that are available, and then you do a best execution based on the orders that are put onto you versus the exchanges that you guys are integrated into. So far,
correct.
So easy to understand. So why AI? Where's that come into it?
Great question. So one of the biggest problems with liquidity aggregation is the fact that exchanges are still, 20, 30 years behind. And that means that there's a lot of latency. So even if you're aggregating equity markets, right, you need to minimize latency. Why do you need to minimize latency? To minimize slippage and gap risk. Meaning, I'm here in Dubai today, and I am going out, sending an order to a Binance server that's in Hong Kong. There's a round trip there. Mm-hmm. And that round trip causes latency. And it could cause latency of, say, half a second, right? By the time I buy and sell and I do my action. Mm-hmm. Now, that half a second, we've calculated in a volatile market can equal up to 2% gap risk. Right? So you need to minimize that risk to zero. Now in equities, with all the quant-based strategies that a lot of the liquidity aggregators use and all the high-frequency traders use, they've minimized that using quant strategies to say, 100 milliseconds or 50 milliseconds, right? Now, there's still a gap risk there. And what we do is the big problem with crypto markets versus, say, equity markets is that crypto markets are non-linear. Meaning that if you just use quant-based strategy alone and sort of technical trading, you won't get there. Otherwise, we'll all be rich sitting on a beach somewhere, right? Crypto markets are notoriously complex and driven by sentiment, driven by gold prices, CPI indices, lots and lots of different features and aspects. Data is highly unstructured. Elon Musk can make a tweet right now, and we've seen over the last few days with Doge, pops 15%.
Yep.
And so the reason we use AI is we use it as a tool to make sense of unstructured, non-linear, complex data to try to predict that latency, right? So far, we've been able to go we basically have partnerships, two academic partnerships, one with Imperial College in the UK and one with Blekinge Institute of Technology in Sweden, with about 15 postdoc researchers working on this day and night, full time. And these guys, they make sense of all these data using different features. And what we've been able to do is effectively up to 8 seconds, we're able to predict BTC and ETH to up to 99.5% accuracy. And up to 30 seconds, the accuracy goes down to about 95% using our hybrid models. And that's really where the magic is.
If you can do that, then why not just trade on it yourselves?
Very good question. That's exactly what FTX did. So we are purely a liquidity aggregator. Our business model is very, very
FTX borrowed its users' funds, right? But being able to predict the market and then creating a quant trading strategy where you bring in investors' funds to go and trade the market on that is completely legitimate business practice. It's not.
That's very true. I mean, that's something. Creating a trading strategy is one whole. It's a whole ball. It's a whole sort of. It's a whole new world.
Right.
What we are doing is simply creating ultra low latency technology for best agency. And I think as well as coming back to the FTX example, you need to be able to divide church from state.
Sure.
If you're prop trading, right, and this is why banks have Chinese walls.
Yes, I agree. I'm just saying why build the aggregator?
Why this business model?
Right.
Yeah. I mean, the business model is just different. I think where we see a big gap in the market, the problem we're trying to solve is trying to be a liquidity aggregator. We're not just trying to make a quick buck here.
Right.
We can probably, but then it just it would be a different company. It would be different people.
So why do you think that a liquidity aggregator is so needed, or your type of liquidity aggregator? Because there are other liquidity aggregators in the market, right? There are both centralized exchange aggregators and decentralized exchange aggregators. So what is it that you guys have seen that made you go, okay, if we're able to provide a product that does this, it's going to be, this much better than what is already available?
Great question. I believe that if liquidity aggregators were working, we wouldn't have any arbitrage in crypto right now.
Okay.
But you have lots of arbitrage. The problem is still there. So clearly the aggregators aren't doing enough. It's not a one player eats all market. You need 30, 40 liquidity aggregators in the market to be able to solve this problem.
Right.
Us alone, we're not enough. We need an ecosystem of liquidity aggregators. So, of course, liquidity aggregators, the more there are, the more liquidity comes into the system. So the problem isn't being solved.
Yeah.
That's ultimately why we're here.
Yeah. It's interesting because I always think of them as separate problems. Like order routing versus liquidity provision. I think of them as separate problems to some extent, right? Because you have the sort of the two sides of a exchange model. It's much simpler to talk about it from the point of view of Uniswap. On Uniswap, you have the liquidity providers, who are the people who provide liquidity to the market, who say, hey, I am willing to buy and sell these two assets. I am willing to make a market for these two assets, and people will come here and they'll take whatever the price is given the ratio between these two assets, right? On a centralized exchange, it's a bit more complicated. You have professional market makers and professional traders who will sit on the order book and take a view, either a balanced or biased or unbiased view, balanced or unbalanced view, on what the price is going to do, and provide liquidity close to spot or away from spot, where they're making a market. And then you have the takers, the people who are coming to the market and going, I need this executed. And liquidity aggregation, or what Fluid is doing, sounds like it's making execution more efficient, but it doesn't sound like it's actually adding more liquidity in the form of the makers.
It's a good question. So what you described is basically market makers, takers within one CEX. It's one centralized exchange.
Yep.
What we're doing is connecting all the centralized and decentralized exchanges together. Yep. At the moment, there's about 500 of them.
Yep.
Right. And in terms of who we're providing this for, we've got sort of three main buckets of users. We've got the institutional users, high frequency traders that want best X, that need best execution to be able to buy and sell crypto, either spot or futures, right, at the best possible price, because 10 bips, 5 bips makes a big difference when you're trading 1,000 Bitcoin, right? The other user sort of pillar are exchanges.
Yep.
And while tier one exchanges, the Binances, the Krakens, have ample liquidity, I was going to make a joke and say the FTXs, but they don't anymore. The tier 3, tier 4 exchanges that exist in the world. So here in the Middle East, we have, CoinMina or BitOasis. These guys, they get their liquidity from maybe one, possibly two exchanges. So their user base, so 30, 40,000 user base, are really just they're using them as a proxy to access that liquidity. Now, if those exchanges, those tier 3, tier 4 exchanges used Fluid, they'd get access to 300, 400 exchanges, meaning that their order books thicken, right? You get better execution, better pricing, lower latency. Everyone's a winner,
right? Okay,
and that's how we help. That's how we help the kind of the exchange market. So we have institutional, we have exchanges, which are main sort of two, and then later on we also have the retail markets as well. So we'll have a very sort of simple user interface, and you'll be able to get.
That sounds like it might. That sounds like it might lead to an interesting problem. I'm not sure what to call it. Like, if I'm a tier 3 exchange, I'm a tier 4 exchange, and I'm using a liquidity aggregator to essentially mirror the books of other exchanges. So I'm going, okay, I may not have much liquidity directly on my exchanges, but I'm using a liquidity aggregator where I'm able to aggregate together a bunch of liquidity from other exchanges, and then I'll offer that up to my users for as a liquidity aggregated order book. And then I quote an order book on my exchange. Then is there not a possibility then for other liquidity aggregators to think that that is the actual liquidity of that exchange and not aggregated liquidity? And you end up with basically a circular reasoning in the system where the mirrored liquidity on exchanges that's being quoted as their own liquidity is then being re-quoted on other exchanges as mirrored liquidity from, do you see where I'm going with this?
Yeah, I do. I think that's exactly what happens in traditional markets, and that's a
Right.
good thing in a way that, you know, you it's a very the whole problem here is that crypto is still very nascent. Crypto markets are very nascent.
Yeah.
And so you always have this problem. Now, with the tier 3, tier 4 exchanges, what that does is all we do is give them an avenue to get better pricing and better flows.
Yeah, I suppose my point is I'm basically double counting, right? So let's say that we've got you guys are doing really well and you're working with tier 2 exchanges, right? And
Yeah.
so the tier 2 exchange is aggregating from Coinbase or aggregating through you, and then is quoting on its books, and some of that is from Coinbase and some of it is from other exchanges. So let's say that $1 million worth of liquidity for whatever pair is on Coinbase, and then it's aggregating it together and it's quoting $2 million of liquidity on its exchange because it's $1 million from Coinbase and then like $1 million from a bunch of other ones. Now a tier 3 then aggregates from that tier 2 and from the other exchanges. It's still counting $1 million from Coinbase and it's now counting $2 million from the tier 2 exchange. Now it's quoting a $3 million liquidity, but it's double counted because it's counted. The first exchange is quoting from Coinbase and the rest of the aggregators. The next exchange is quoting from tier 2 and tier 1, not realizing that it's aggregated. And now you've got 3 million of liquidity in spot when you don't. You've only got 2 million.
I see the conundrum here, and probably that is a problem that could happen. I guess the way I see this in practice is the tier 3 exchange that decides to aggregate liquidity from tier 2, maybe there is a pass through, right? So if it does take it from tier 2, that tier 2 gets it from tier 1, right?
Right.
There is that problem that will happen.
Yeah.
Now, ultimately, the tier 3 exchange is getting best execution still, right?
Well,
because
apart from the fact that the liquidity that's being quoted isn't actually all there. Like if I came in and I tried to do 3 million, take 3 million, I wouldn't be able to because there's actually only 2 million that can be taken off market. So I'll try and execute 3 million that's being quoted to me, but I actually can't take it. I can only take 2 million. So you get ghost liquidity, basically liquidity that disappears when you try and execute it.
Yes, you do, I guess, and it's something we got to probably think through in terms of how we solve that.
Right.
In terms of, but the way we do this as well is at the moment we're only really aggregating for the top 10 tokens.
Yeah.
We're aggregating order books for those.
Yeah.
We're not really going in and aggregating very deep illiquid altcoins at the moment. We're just really sticking to the top ones, and that's how we get around it for now. I do agree that there is ghost liquidity in the system. There always will be, and that's what happens in equities. It has what happened, but ultimately, right? It's better to have ghost liquidity than to have really poor pricing. And so what that does is that we give a marketplace for people or for institutions to be able to get best execution, the best possible pricing at the best possible terms.
Right.
And that's what we do. That's how we aggregate the liquidity together, and we minimize the spread.
And the AI part of it is then allowing you to more accurately quote to the user what is actually going to come back because you're able to predict what the price movement is likely to be in the next within the latency round
within the next,
trip.
say, 5 seconds or 10 seconds,
Right.
then we know we can give you a live price. We don't, and that takes away a lot of the market inefficiency that happens.
So who's taking the execution risk then? Are you guys taking the execution risk? So if you quote me a price and I say I take it, price and amount, and I say I'll take it, are you now obliged to fill that, or is it better is it an offer and then you'll go and do your best to do what you've quoted?
No, so you're talking about sort of RFQ systems. So there's different types of taking. There's I guess 2 different types. But ultimately you need to have the funds to be able to execute.
Yeah.
Right. We're not in the business of you need to have, there needs to be a sort of a proof of funds.
Yeah.
And just like in any exchange business. So it's not like here's just a price, and then we give you the price and you fund, and then we realize you don't have the money, and then we take the risk.
No. I mean that. I put funds in. You quote me a price. I say yes. Is that price dependent on whether or not you can actually go and get that on the market, or is that the price that I've locked in, given the fact that you already have my funds?
So the sort of order flow, if you like, the user flow would be, we give you a price.
Yeah.
That price you can take right now, this moment.
Yeah.
In terms of how it's all settled, which is, I think your question is more around settlement risk.
Yeah.
And operations risk rather than execution risk.
Yeah.
Or it all constitutes execution risk, I guess. But settlement risk, there are a lot of at the moment. So we use things like Clearloop, Copper, Fireblocks. We use different MPC wallets that have an inbuilt proof of funds. So you would face us as a user. We would face the exchanges.
Yeah.
So similar to sort of a prime brokerage model, if you like. We would face the exchanges. We would have accounts in these exchanges. We would make sure that the trade is actually executed on your behalf on these exchanges.
Yeah, I suppose that the question is who, for me, is who. Let's take a DEX example, right? So let's say that part of it you're routing through Uniswap v3. Now you can get the quote on Uniswap v3 and you can submit the transaction on Uniswap v3, but you may not actually get the funds because you can be front run, and your delay is actually your delay is to Ethereum finality, and Ethereum finality, depending on how you count it, is like 8 to 10 minutes. So you can submit a transaction, it can get approved into the mempool, it can then be built into a block, but then that block can be reordered, meaning that you don't actually get the execution that you paid for on a DEX, and you don't get the funds returned. So then you won't get that price that you quoted, but you've already gone and tried to execute on behalf of the user. So I mean, it's a real technical detail, and either way, it doesn't matter.
It's a very, very good, very, very good point, and it's something that we have been thinking through over the last few months as well, in terms of our product development. And ultimately, the answer I can give you here, sort of from a layman's perspective, is that our AI is built so that it takes that execution risk, and it's able to take that latency, right, that round trip latency, out of the equation, so that when you do execute, it's instant. There is a security there. In any brokerage or any execution platform, there's always a sort of a trigger.
Yeah.
A fill or kill or whatever,
right.
A trigger that if something badly goes wrong, you don't get filled, right? But what we do is that using our AI, we're able to predict so we use different tools for centralized and decentralized exchanges in terms of how prediction models work. And so we're able, with a very high degree of confidence and accuracy, be able to take that risk, right, up to a certain tolerance level. Obviously, if then, from a risk management perspective, you need to have a a level where
Yeah.
if it doesn't work, then it doesn't work.
Over a certain trade size, you probably just be like, nah. But I mean, that's great. That's a fantastic user benefit. That's a fantastic user benefit because it means what price they see from you is the price that they actually get, which is basically exactly what you need. So let's talk about sort of where you guys are. You are in development. When you expecting to launch?
So we've just launched our MVP this week, in fact.
Congratulations.
Thank you. We have had our proof of concept sort of done. All the AI models are ready, and it's just a case of now getting it from MVP into a production alpha model, which we're hoping to have Q1 next year.
Yep.
So yeah, that's sort of where we are from a tech perspective. We've grown the team during this sort of winter, crypto winter. We've used it really to buffer up our tech resources, getting some really good people on board, and really growing as quickly as we can, so that when the bull market does come back, we are good to go. And you know, we're a piece of infrastructure. We're not a we're a piece of infrastructure that aggregates, that solves the problem that is even more exacerbated now with FTX and with Luna and all these projects failing. The crypto liquid, and you know, we're still big believers in crypto. We still know that it's gonna take over. Especially with, you know, DeFi, it solves a lot of problems. I mean, this is not the forum for it, but that's what we're here for. We're just a piece of infrastructure to help people get better execution.
And so, where's your vision for this take you? Like, what's the big like hairy end state of this?
Yeah, I mean, I think there are a lot of markets right now that we are looking at. So at the moment, we are focused on spot markets, but we see that crypto markets are going to evolve. There's a lot of interest in futures and options at the moment, especially from institutions. So our liquidity aggregation will go in that direction. The third direction I think was going to happen, and we're sort of penciling in mid-2024 for this, is generally tokenized markets, any tokenized markets. You know, we're seeing real estate being tokenized. We're seeing pretty much everything, even NFTs being tokenized.
Sure. Fractionalized NFTs turn a non-fungible asset into a fungible asset. Yeah.
Anywhere with a tokenized market, we can connect to. So I'm not limiting this to centralized exchanges and decentralized exchanges, which, you know, in reality, the user base is quite small still. And it's got even smaller. But really, you can't shy away from the technology here. And I see this going in the direction of pretty much any tokenized market. You know, there's nothing to say that, it's well documented as well. A lot of big corporates at the moment are looking at doing tranches of debt, even IPOs, in tokenized form.
Right.
You know, that's where you can use Fluid in venues where these exist. You know, we've had a whole bubble of NFTs, right? But there is certainly a marketplace for non-fungible tokens from a retail standpoint. You know, you hear even Instagram or OpenSea's having their own NFT marketplaces, and there's nothing to stop Fluid going in and providing liquidity aggregation in those markets as well. So I see anywhere that has a market, we can go in.
Anywhere that has a market where the underlying asset is in more than one venue.
Yeah, is in more than one venue. It's tokenized. It's digital.
Right.
We can help.
And you mentioned retail in here because, like, your first two sort of customers, trading houses and exchanges, that makes sense. But sort of, how does retail fit into the Fluid vision?
Well, it's a funny one because crypto ultimately is still a retail product. It's still traded by retail.
Yeah.
Mostly. Retail forms about 92% of total crypto volume on centralized and decentralized exchanges.
Yep.
So it's not really a market that you should ignore. That said, there are a lot of legal, compliance, moral questions with dealing directly with retail customers. So being regulated for us is a big thing. Being able to garner that trust for lower tier or sort of less sophisticated investors. So certainly we have a B2C strategy in place, but at the moment the way we're getting to that C is through B2B. So it's kind of B2B to C, if you like. So through these exchanges, through those big institutions, trading houses, we can get to the retail because they directly deal with them. But yes, we do have a retail product. We have a token as well. We haven't launched the token.
But you will have a token.
We will have a token, but it's we are TGE ready. It's just a case of making sure that the right market conditions prevail before we launch our token. We don't want to launch it in this market for obvious reasons. But yeah, we have a token strategy, and that token really is for retail to use as a gamified strategy on our platform. So we're going to have a very simple retail focused UI where you can use tokens in the same way that you use BNB on Binance.
Okay, that's really cool. That's it. I mean, it sounds like a really cool project, and I think that liquidity aggregation is obviously, as the industry gets bigger and more venues for exchange and trading and all this kind of stuff emerges, there is going to need to be this increasing layer that brings it all together again. So I really am excited to see what happens with Fluid, as well as this AI predictive model where on the other side you're giving a guarantee of sort of a price that's being quoted. I think all of that is going to be immensely valuable for the industry. So Ahmed, it was such a pleasure having you on. If people want to find out more about Fluid, where should they go, and how should they reach out?
So we have our website, which is FLUID.finance. There you'll find all our social media platforms. We're very active. We have a very active retail community on Telegram as well. We're in a we have a lot of you see us a lot in the media, on CNBC, on Bloomberg, on Forbes. So you can find us around there, but really the best place to start is the website. You learn a lot about the project. If you want to get involved in the token as well, a lot of information on that. And I think that would probably be the best thing. Would you be publishing it maybe on this podcast?
Oh yes, this will also go out on our socials as well. So you can, and we'll add the information about Fluid into the show notes so that people can find out those links. Ahmed, it's been such a pleasure having you on. Thank you so much for coming on the show.
Thank you so much, Piers.
More utility, then you better call on these guys. I'm going radical, I'm going Radix, I'm going radical, I'm going Radix. Hyperspeed DeFi, never on a decline. Building the future, I feel like a savage.